All right, I think we're going to get started today. So good morning, everyone. Thanks for joining us today for the Kerber Rose 1099 and Year-End Payroll Webinar hosted by Melissa Schwartz. We're so excited you all could be here with us today to learn more about the basic requirements and collection of information on 1099 processing, year-end payroll information, and what's new to come for 2023. Before we begin, just a few housekeeping items to keep track of. There is a Q&A feature available. It'll be located by the settings and info button, which you can use to ask Melissa any questions throughout the presentation. But don't worry if your question doesn't get answered right away, or if you think of one after the fact. We have that space designated at the end. Be recorded and made available for later viewing, so watch out for your email box. We'll be sending that out hopefully within a few days of the webinar. But now that we have those basic items covered, it is my pleasure to introduce to you our presenter for today, Melissa Schwartz, CPA and Shareholder here at Kerber Rose. She will be discussing payroll, accounting, and tax information for 1099 processing. She has 15 years of experience and has been here for 15 years. Without further ado, I will be handing it over to Melissa and she can kickstart this presentation for us. Thank you.
Thank you, Lauren. And I want to thank all of you attendees and any of our Kerber Rose employees that are joining us today. So today, discussion topics, we'll be going over 1099 processing, basically the basic requirements of 1099s, collection of information to prepare 1099s. I'll bring up a couple of the forms just to kind of show you what information goes where. For year-end payroll processing, just basically going through a few year-end add-ons or things we see towards the end of the year that impact W-2 reporting. And then also I'll go over some things that I've seen throughout 2022 with our clients, that items to be concerned or to think about. And lastly, while there's not much new for 2023, we will briefly touch on 2023 items. So let's hop right into it. 1099 miscellaneous, basically the basics here. So for those of you that have been in the 1099 processing arena for a few years, a couple years back, they broke out the miscellaneous 1099 and they added a 1099 NEC, which is basically non-employee comp. So we'll touch base on the miscellaneous and the NEC today. So when to issue a 1099 miscellaneous? Your business has paid at least $600 for rent, royalty, prizes, and awards, other income, or medical and healthcare payments. There are other reasons to issue a 1099 miscellaneous, but I left them off of today's discussion just because they are very specific reasons. So make sure that you're still following the instructions, and I'll give you a link to those in the next slide. 1099 miscellaneous should be sent to individuals and partnerships, but we generally do not send them to corporations. There's two exceptions there, common exceptions. That would be attorneys or law firms they're always required to receive a 1099, and you're going to use the 1099 miscellaneous to report if the payment was made in response to a legal settlement and not for legal services, and that would go in box 10. The legal services piece to attorneys is going to fall on that 1099 NEC, and again, we'll go over that. Secondly, corporations that receive medical and healthcare payments are still required to receive a 1099, even though they're a corporation, and that includes veterinarians. One common question we get is, what about LLCs? And basically, that depends on how the LLC is taxed. So corporations or S corporations are not required. And we will see a screenshot of the W-9, and I'll point that out how you can make that determination when collecting information from your vendors. This slide here is basically to give you the due dates for the 1099 miscellaneous. They must be provided to the recipient by January 31st. The 1099 miscellaneous and Form 1096 is going to be due to the IRS by February 28th if you're using the paper filing method, or if you're filing electronically, that is going to be March 31st. The state of Wisconsin requires those to be submitted or e-filed by January 31st. So generally, rule of thumb I always say is they're just due the 31st of January. And Wisconsin does have a requirement that you must e-file it if you have 10 or more information returns. And they use that information returns in total. So if you had 2 1099 miscellaneouses and 10 1099 NECs, that is going to get you over that 10 filing threshold. The resources I have listed here are basically instructions for that 1099 miscellaneous. And I can pull those up real quick. So for both our 1099 miscellaneous and NEC, they now have combined the instructions, and they are going to treat these as continuous forms. And what they mean by that is they have now started to omit the date from the form, and it will allow for these instructions to not be needed every single year. So they'll just start revising them rather than having a 2022 instructions manual. This is going to be a general instructions for information returns. This includes the 1096 and the 1099s. You're going to find all your specifics you need in there, or any questions you might arise. The publication 117 is going to be our guide for the state. This kind of gives you the chart of when is the miscellaneous required, when is it due, and then your options for reporting. It will give you suggestions for if you need to send electronically, how you might do that. You can, use My Tax Account or things of that nature. Back to my PowerPoint here. So those are my 3 resources. Whenever I have a question, I go there first. So look at those if you have any specific questions. I'm going to hop into 1099 NEC basics now. So NEC stands for non-employee compensation. This is going to be the forms if a business has paid at least $600 for services performed by someone who is not your employee. And when they created this form, they started including parts and materials behind that verbiage. And basically what that means is I have a slide coming up. We'll look at that. Materials and supplies incidental to the service should be included in the amount recorded on the 1099, even if the vendor or subcontractor separates out labor versus materials on the invoice. So basically what that is saying is feel free to include the whole amount that you paid them, even if there is parts and materials versus labor. Examples of services: professional service fees such as accountants, architects, engineers, consultants, etc. Commissions to non-employees, repairs and maintenance services, advertising services, directors' fees, payments to independent contractors, payments for services for your rental property. So that last one is just to point out that if you do have rental property and you're paying a contractor for something, you do need to consider sending a 1099. Again, 1099 NEC should be sent to both individuals and partnerships, but generally not to corporations. And here we're going to go into the exception again. An attorney is still required to receive a 1099, and legal services are reportable in box 1. And again, what about LLCs? Depends on how they're taxed. Corporations or S corporations are not required. And that I covered with the materials and supplies. Again, due dates. This one's a little bit different than the 1099 miscellaneous for federal. They want these by January 31st, if it's paper or electronic. And the purpose of that is to really make sure that people aren't filing tax returns with omitting reportable income. The state due dates are January 31st. Again, you should be e-filing if you have 10 or more information returns. Same links for 1099 miscellaneous as 1099 NEC. So now I kind of want to go into how can we collect the information to prepare our 1099s. Form W-9 is the request for taxpayer identification number and certification. So basically anyone that we feel falls in either the bucket of paying rent, royalties, the 1099 miscellaneous, or in the bucket of 1099 NEC where they're providing services for us, we want to send them a W-9 for them to complete. Once we get this form completed, we use it to decipher whether the 1099 is required. So I was hoping I had a little bit better screenshot. Let me just pull up the W-9 real quick. So this W-9, again, is completed by your vendor or the person that you're paying. And they should be completing these fields to tell you how to report the 1099, this information we are going to use to fill out the 1099. So an individual, sole proprietor, or single member LLC are basically individuals in the eyes of the government. A C corporation is a corporation. They would not be required to have a 1099 issued to them, and again, unless they're an attorney or they're providing medical services. An S corporation, same as the C corporation. Partnership, you would need to issue a 1099. The trust and estate arena, that's not very common. We won't touch on that today. The limited liability company, that's the LLC. If they check that and they mark that they're a C corporation or a S corporation, again, not required to receive a 1099 unless medical or attorney. A partnership would. They should be filling in their address, their city, state, zip. You can put your requester's name and address when you send that to them, but that's optional. And then they should be entering in a social security number if it's an individual, or their employer identification number, you know, if it's a business. Let me hop back to the PowerPoint. You keep that form in your records at all times. And that will be important for us to complete the vendor information in our accounting software so that we can pull the information for the 1099 reporting. Best practice, get these things immediately when you're paying your vendors or subcontractors. Don't wait until the end of the year to sift through your accounting records to see who you haven't received this for. In fact, if at all possible, try to get it prior to issuing the first payment. That's when you're going to have the most luck. Technically, if you have a vendor or subcontractor that does not complete this request, you should be implementing backup withholding. For 1099 vendor subcontractor purposes, the withholding percentage for backup withholding is 24% for federal. And there's additional resources for backup withholding because that is actually quite complex. I included the link there. If you get into a situation where you need to do backup withholding, you should be viewing that guidance. Once in a while, we'll issue 1099s, and then the IRS will come back to us and say there's a mismatch between the vendor subcontractor social security number and what you put on their 1099. So basically, at that point, you're supposed to have them complete a new W-9 and with the correct information. And again, if they don't do that, then you need to start with the backup withholding. Lastly, learn your software. So just making sure you know what fields you need to put this information in your software so that when it comes time to consolidate everything, you have it accessible to you. I did a couple of screenshots of QuickBooks Desktop vendor entry screen. I use Kerber Rose. Kerber Rose is a corporation, so there is no requirement for a 1099 to be issued, but for sake of this presentation, I use that as the vendor name. You would, in QuickBooks Desktop, enter the vendor tax ID from that W-9 in that field, and then put the checkbox that they are eligible for the 1099. For me personally, sometimes if I get that W-9 and it tells me that they're an S corporation or a C corporation, I'll enter, and they still provided me the tax ID number. I'll enter the tax ID number, but I will leave the vendor eligible for 1099 checkbox unchecked. And that is just a way for me to know that, to know quickly in my records that, oh, I did get the W-9 and they weren't eligible for 1099 reporting, or not, it wasn't required. QuickBooks Online vendor entry screen looks a little bit differently, so I just threw a screenshot out there. Same practice. I think at this point we're done with 1099 processing. I'm gonna just pop up actual form, the forms to just go over briefly. As I know we had a couple questions prior to the start of today that people wanted to go over. So this IRS form PDF basically presents to you the way the IRS would want these forms if they were receiving them in paper. So when you request forms from the IRS, there's a way to request them, or you can get them from Office Max or tax form suppliers. What they're going to do is they're going to send you the various copies. And this copy A for the IRS is going to be in red font. They're going to want the actual form paper. Just printing this in color isn't going to allow them to use it the way they want to use it because of the way they feed it through machines to read the data. So best practice is to actually order the forms rather than try to print these. But basically, you're going to have the dual copies. And this will be the same for 1099 NECs. You have the dual copies because there's reporting to various agencies. So copy A in this instance would be the copy you would send to the IRS. You're filling in the business name, the payer's name, so you or the business that you work for. The recipient's TIN, so that's going to be that EIN or that social security number that you get from the W-9, and then the name, address, and this here is going to be whatever you're paying them, whatever you paid them for, whether it be rent, royalties, other income, that's going to be the awards. If you had to do that backup withholding, that's where you're going to have that federal income tax withheld. This is where they're getting away from the form years. So now you're going to have to start entering them the last 2 digits of the calendar year. Those medical and healthcare payments that we talked about go into a separate field. And then on the 1099 miscellaneous attorneys, this would be for legal settlement purposes. That would go in box 10. You can see there's some other options here. Those are all within the publication. If you need to read more about crop insurance proceeds, fishing proceeds, deferred comp, and those types of things. This copy 1 is just a duplicate, but this is going to be what gets sent to the state. Now, again, the state is really cracking down on electronic filing. So if you have 10 or less, fine, send it in. But you're going to want to make sure that you have your state tax number on here. I've seen it where they've had no state tax withheld and no number where they've accepted it. And I've also seen it where they get a little upset. So if you have a state ID number, that would be your state withholding ID number. Just throw it in there, make them happy. This mailing address is going to be in that publication 117 if you have the 10 or less information returns. And then, of course, the copy that you send to the recipient. So copy B. Copy 2. We don't see copy 2 a lot, but this would be a duplicate copy of copy 1. This is basically just the recipient, another recipient copy. And then copy C would be for us, for our records. Sometimes there's a copy D called filing copy that we also keep for ourselves. That's Form 1099 NEC. A little bit smaller because it only reports non-employee compensation, but again, same concept. There's different copies. Copy A for the IRS, copy 1 for state, and then the remaining for the recipients. Again, payers here, payers your EIN, recipient's EIN or social, their name, address. Federal income tax, state withheld if needed. Again, throw that state ID number in there if you have it. Lauren, do we have any questions on 1099s?
Right now, I don't have any questions in the queue, so I think we're good on that.
All right. All right, we will hop into year-end payroll processing. Just start with some important things. So just remember, we want to make sure the spelling of our employees' names are correct, social security numbers and addresses are accurate, so the forms are getting to the employees timely and accurately. The Social Security Administration will not process a Form W-2 with misspelled names, incorrect formatting, and social security numbers that do not match those in the Social Security Administration system. So consider using the Social Security number verification service. I put a link to that. It's pretty easy and it's accurate. It gives you, for those of you that might be filing a lot of 10 or W-2s, it's probably a safe bet to do that because you might establish those errors and then fixing them becomes a little bit more difficult. Also consider having a formal review done by employees once a year prior to year end to confirm their information. So if you can send something through HR or just a general reminder with their pay stubs or however you might be able to communicate them to, this is what we have for your address. Is it accurate? And then we'll just hop into some topics of concern, just that you should be aware of when it comes to W-2s and compensation in your employees. So one thing we get asked about are awards, prizes, and gifts to employees. General rule is you include the value of all items provided to employees as taxable compensation, unless the item may be excluded by law, regulation, or agency position. So one thing, length of service, safety awards, and gifts. There are cases where it may be excluded from wages. With, there's certain requirements and certain limitations. So the limitations here for a length of service safety award gift is it has to be in a qualified plan. Or I shouldn't say that. If it's in a qualified plan, it's subject to a $1,600 limitation to a single employee. And the average cost of all awards made by the employer cannot exceed $400. Qualified plan, a non-qualified plan is just basically a $400 limitation to a single employee. Both of these must be presented in a meaningful ceremony. And basically the circumstance of the award must not indicate a likelihood that the award is disguised as pay. So we can't just pull off $400 from their salary and disguise it as a service award. The length of service award must be in recognition of at least 5 years of service and provided the employee did not receive an award in the previous 4 years. Gifts to those who are retiring are considered length of service awards and may be excluded from income to the extent they meet the rules and limitations discussed above. De minimis, I don't have these on the slide, but something I thought of, de minimis benefits or working condition benefits may be excluded from taxability. The item must be low in value. It must be difficult to determine or administratively impractical to track and apply to the employee. The benefit is occasional and not consistently awarded, meaning there's no expectation that happens. The employee isn't expecting it from you. And they have a kind of a list of other items that remain de minimis despite not meeting all those criteria. Those include tangible items like small traditional birthday gifts or holiday gifts of property, items, not cash, with low fair market value. One instance mentioned is a turkey given to an employee during year-end holidays, or a flower, fruit, books, or similar property provided to the employee under a certain special circumstance, like an illness or outstanding performance or a family crisis. But again, nothing that the employee is expecting from you. To jump back, sorry, I missed this. Safety awards are considered tax-free to employees if up to 10% of the employees may qualify for their award. Awards to professional, administrative, and clerical employees are not eligible for tax-free treatment. Basically, they're saying those types of professionals aren't really in a profession that is unsafe, so to give them a safety award wouldn't really be necessary. Awards for employee suggestions are taxable. Gifts to employees are included in taxable income. Again, exceptions, low in value, difficult to determine, benefit is occasional. So going back to those de minimis benefits that I was just talking about, gift coupons cannot be excluded from income as a de minimis, and basically that's because they're not difficult to determine value. Because if it's a gift coupon, it's likely for a $15 item or something along those lines. So in place of the turkey, if the company provides a coupon, you know the value. So it doesn't fall under those de minimis rules. Cash and cash equivalents, gift cards, certificates, entertainment, stocks, vacations, bonds, or similar items are not excluded. So those would all be considered taxable. Next topic, supplemental wages. Supplemental wages include bonuses, commission pay, overtime pay, accumulated sick pay, severance pay, awards, prizes, etc. We have a couple methods of withholding for these supplemental wages. There's the aggregate method of withholding that basically combines that supplemental wage with their regular pay. And tax is withheld using the applicable withholding tables for payroll period in which those aggregated wages are paid. Such additions to pay may mean that the total amount is taxed at a higher rate for that particular pay cycle than the rate normally applied for employee. We find this to be more and more common with the automation in our payroll softwares and just trying to keep a defined payroll cycle. So a lot of times we're seeing these items just getting ran through with this method. It's basically just adding the bonus to the normal payday. It also is a little bit easier when you have when those supplemental wages are included in your 401k calculations. A lot of times there's this notion that I can exclude bonus or some of these supplemental wage items in the employee deferrals and the company contributions, but that is not the case. You have to look at your 401k plan to see what the definition of wages is for that. You can't just, because it's a bonus, think that it's not, you shouldn't be doing those employee deferrals or those company matched. That's a general misconception. So always look back at your 401k plan, see what the definition of wages is. And I shouldn't say just 401k, I should say your retirement plan. And that's one reason alone why you would choose this aggregate method of withholding. It just makes it a little more simpler on you in that regard. Another method of withholding for supplemental wages is the optional flat rate withholding method. So if you want to have it on a separate payroll run, basically you should be using 22% withholding rate for federal. And then Wisconsin has these approved flat rate percentages, and I included their chart for 2022. So the supplemental wage payment in this must not be paid concurrently with regular wages, or it must be separately stated on payroll records. So basically a separate payroll check or a separate payroll run. To note, for accumulated supplemental wages exceeding 1 million, the employer is mandated to withhold the 37% rather than the 22%. The next topic we're talking about today is year-end W-2 adjustments. The first of that being personal use of company vehicle. I think this is probably one of the year-end W-2 add-ons that get overlooked the most. As a payroll processor or someone that's in the payroll department, we don't always know when, especially if it's a larger company, if the employees have access to company vehicles. But I would bet that with our increased budget for IRS agents, that when we start seeing audits, that this would be an area of concern, just because it's easily trackable for the IRS. Generally, if you have multiple vehicles on your depreciation schedule that are like in commuting type vehicles, they are going to be able to make a general consensus that some of those are being provided to employees. So we'll talk about this. I want to emphasize these slides only include the basics. Each one of the ways to value the personal use of company vehicle has quite complex rules. I mean, each one of them would have been multiple slides. I want to point out that all of that detail is in publication 15B. I will have that link provided later, but we'll get started with personal use of company vehicle. It is a taxable non-cash fringe benefit. So it's personal use of the company car, commuting to and from work, running a personal errand, vacation or weekend use, and even use by a spouse or dependent. This company car fringe benefit is considered part of the employee's compensation for tax purposes. You have to determine a value, include it in employee wages, and withhold taxes on it. The reportable amount that you add to an employee's compensation for that can be included in box 14 of the W-2. Now we'll get into the valuation rules. Again, multiple rules, a lot of detail in all of those rules. So just if you're choosing one, make sure we understand it fully. General valuation rule, general valuation rule. The valuation would be what the employee would have to pay a third party to lease the same or similar vehicle on the same or comparable terms in the same geographic area where the employee uses this vehicle. So some people call this the fair market value rule. It's basically what's the fair market value to the employee. You can't just use some of these. You have to know what is going to be allowed for your business. I'm going to point that out again. Commuting rule. So this is the amount of each one-way commute from home to work or from work to home multiplied by $1.50. There's extensive requirements that must be met. There must be a written policy. No additional personal use besides commuting. It has to be a non-control employee. And again, that publication 15B will define that non-control employee. And commuting is required. So, and provided it's required by the company in the provided vehicle for non-compensatory reasons. The cents per mile rule. Employees can use the business standard mileage rate, subtracting as much as 5.5 cents if the employer doesn't provide fuel. And that's basically multiplied by the total miles the employee drives the vehicle for personal use. The following requirements must be met. So it must be regularly used in your trade or business. And there's a mileage test. Again, publication 15B will have that mileage test. Fair market value of the vehicle cannot exceed $56,100. The annual lease valuation rule. This is the one I see used most commonly. Employers use the annual lease value of the vehicle as specified by an IRS table that bases annual lease value on the auto's fair market value. And that value, and again, that lease value chart is in publication 15B. Basically, you find the value of the annual lease value and you multiply it by the percentage of personal miles versus total miles driven by the employee. And you can also adjust this for the fuel adjustment of 5.5 cents, depending on who's paying for the fuel. If you have an employer operating in a fleet of 20 or more qualifying autos, You can use an average annual lease value for every qualifying vehicle in the fleet. So it just makes it a little bit simpler for those that are, for employers that have 20 or more. Again, that goes into great detail in publication 15B. In that method, fair market value of vehicle cannot exceed $56,100. So maybe have a lot of salespeople with cars that you might be able to use that. Probably not a lot construction with trucks, because you're going to probably find that that value of that truck is more. Are we good on Q&A, Lauren?
Yep, still doing good. I don't have any in the queue right now.
Thank you. All right, so another year-end adjustment is specific to S corporations. Employer paid health and accident insurance premiums paid on behalf of an S corporation shareholder who own at least 2% of the company are deductible to the corporation and are reportable as wages on the shareholder employee's W-2. So basically, we call it the S Corp health add-on. We determine the premium, the full premium amount that the employee or the employer pays, and we go ahead and add that in box 1 and box 16 of their W-2. It's not subject to Social Security and Medicare taxes, and that gets reported in box 14. And in provided their wages are high enough, provided their other wages are equal to or higher than the premium that we add in, that becomes a deduction individually for them on their personal tax return as self-employed health insurance. So it's just a reporting requirement. It really doesn't impact the shareholder in the tax world. Rules of attribution do apply to that. So if you have a S corporation that has a lot of family members the family members of the shareholder working in that S corporation, we just need to make sure that those employees get similar treatment if they fall under the attribution rules. So if you have that, it's best just to reach out to one of us here at Kerber Rose to get what that rules of attribution mean. Another common W-2 adjustment is the group term life insurance. So employers are generally required to impute amounts as taxable income for employer provided group term life plans that exceed $50,000 in benefit value. So again, this is part of a group term plan. Basically, to figure the cost of the insurance to include in the employee's wages, you're going to be multiplying the number of thousands of all insurance coverage over $50,000 by the cost shown in table 2. So to the right there, I have cost per thousand of protection for 1 month. So if it's $100,000 insurance policy, you subtract 50,000, divide that by 1,000 to get your cost per 1,000. You are going to use the employee's age on the last day of the employee's tax year. And you must prorate the cost from the table if less than a full month of coverage is involved. This is subject to Social Security and Medicare taxes. So when we do that add-on, they are going to be subject to that, but not to FUTA. I see this 2 ways. I see the group term life insurance being added as a normal payroll run. And in that case, the Social Security and Medicare taxes basically reduce the employee's net pay from that pay cycle. Otherwise, we see it as an add-on in which we figure out that amount, we gross it up for Social Security and Medicare, and basically the company is paying for the employer's portion. We just need to make sure that it's getting reported as taxable for those two types of wages along with federal, and that the taxes are being withheld properly. In addition to, this is still considered group term life, but this is for an employee's dependent. So if they offer group term life insurance coverage for an employee's dependent, plans that exceed $2,000 must include the entire value in the employee's taxable compensation. So basically the cost of whatever that insurance coverage is. Most of the time you don't see this because the group term, the person that's offering the benefit knows this, so they don't have that plan exceed $2,000. Once in a while we see it. Other considerations, a couple of years ago, there was changes with moving expenses, so they are still 100% taxable through 2025, except for some instances for active military. State might have different policies on this, so Wisconsin follows federal rule, but if you're have multi-state employees, you might want to consider looking into moving expenses on whether they're taxable or not. Employer paid education not related to the employee's job is going to be taxable. There's extensive rules about this as well. So, you know, it all kind of stems down to having a qualified plan, whether it's available to all employees, things of that nature. So if you are, you know, trying to offer an incentive for education, always touch base with us to make sure that you're treating the taxability of that properly. If we have non-accountable business expense reimbursements or allowances, those are technically taxable. So basically a non-accountable plan, you're basically reimbursing an employee without receipts or without expense reimbursements being submitted properly. Another thing we see a lot is health savings accounts. So again, if it's part of a Section 125 cafeteria plan, you should report all employer and employee contributions to that health savings account in box 12 with code W. If it's made outside of a Section 125 cafeteria plan, you should be including that in gross income, and it should just be reported as wages on Form 2 in box 1 and 16. Basically what I'm saying there, the difference is if the employer just has their HSA plan on their own or whether it's through a Section 125 cafeteria plan. If it's through a cafeteria plan, it can be pre-tax across the board. If it's not, we should really be treating it as taxable gross income, and then the employee will get the deduction for that when they file their personal income tax return. These are just some additional resources. So publication 15A, I'm just going to hop back here. Publication 15A is just the employer's supplement tax guide. This is going to help you who are employees, what are independent contractors, employees of exempt, special rules for clergy, sick pay reporting. It just gives you a basic overview of all of those types of things. Publication 15B, you've been hearing me talk about this a lot. This is going to be your fringe benefits. If you have anything going on, employee provided cell phones, lodging, commuting, tuition, this is where you're really going to find a lot of the details for that. This is where all the personal use of auto rules are held as well. And then lastly here, these are just the general instructions for forms W2 and W3. Usually this will cover the fringe benefit. This will help you decide where it gets reported on the W2. if you get into the different boxes, sometimes it's helpful. They'll go into a little bit more detail of what should be included there. And like health savings accounts, it gives you a great definition of what you should be redoing and what you shouldn't be doing. Hop back to the PowerPoint. So just resources for you in that regard. And then just some other basics or suggestions. It's best to include all year-end W-2 adjustments as a payroll run. And what I mean by that is don't take your payroll record and just say, oh, I need to increase X employee for the S Corp health insurance because, and I'm just going to add it to this box rather than running it through a payroll run, because all of those add-ons also apply to your quarterly and yearly payroll tax returns. So if it's only getting added as a W-2, you're likely going to have a mismatch notice from the Social Security versus the IRS. Here are some dollar checks or balance checks. They're basically limits on the W-2. So box 3, Social Security wages for 2022, they should not exceed $1,407. The Social Security tax withheld, because there's a Social Security wage cap, the tax withheld should also be capped, and that's $9,114. Box 12, codes D and E, those are both related to retirement plans, should not exceed $20,500 for employees younger than 50 and $27,000 for employees 50 and older. Box 13 is the retirement plan box, and that should be checked if the employee is an active participant in a qualified retirement plan for any part of the year. In other words, this should be checked if the employee is covered for the tax year by a defined benefit plan and eligible to participate, or covered by a defined benefit or defined contribution plan. So it's basically that retirement plan box tells a tax preparer whether they were offered to contribute to a retirement plan, which limits some IRA contributions. So if they're eligible and they choose not to, it still was offered. So we should be marking that because they were eligible for it. Other payroll considerations. Oh, let's hop back to just some other W-2 basics. So when we're filing payroll reports and the W-2s, the figures on those reports and W-2s should be based upon the pay date. So if the pay date falls in 2022, that is going to be the figures that we're using for the 2022 filings. You don't have to have all of 2022 hours paid in 2022. You can have 2022 hours that are not paid until 2023. Generally, the best recommendation is you should just follow your normal payroll schedule. Don't just do a separate check run at the end of the year because you think all of 2022 hours need to be paid out. However, the add-on things that we've been talking about, those do need to happen before year end because those should be reported in the year that the value was given to the employee. So the S Corp health would be, need to happen in 2022. The group term life would need to happen. Same with the personal use of auto. All right, other payroll considerations. Just a reminder that when someone claims exempt for withholding, that resets annually. That employee should be sending you that form every year that they're exempt. So keep that in mind. There is some administrative relief from penalties from the IRS. So if you're getting a notice and it's like just a mistake you made, and it's the very first time you made the mistake, and for the last 3 years prior to the year of the penalty, know that there is this first time penalty abatement policy that the IRS, they may still subject you to the penalty on the notice, but if you write back to them asking for relief using the first time abatement, they may relieve that. You have to have you have to be current with all your the returns, or an extension is filed, and the tax has to be paid, arranged to pay. So this is just for penalty. I included a link to that first time abatement penalty if you need more information, or again, reach out to Kerber Rose. We can help you with those notices. Another thing we're seeing a lot of is remote employees. And as soon as you have a remote employee in another state, so if your home state is Wisconsin, all your employees are in Wisconsin, but all of a sudden we find an employee that would be a great fit, but they're going to work virtually in Illinois, we need to immediately be concerned with payroll tax laws. So, and it's different for every state. So generally, if they're working in another state, they're not going to be subject to Wisconsin unemployment, but they're going to be subject to this unemployment of that state. And then there's also different rules with withholding. And in addition to that, it could basically create nexus for you in that state for income tax filing for the business as well. So it's just important that before you make that decision, that you're reaching out to us to make sure that that's not going to cause bigger issues for you on a tax standpoint. Another thing that has come up numerous times for me this year, or I shouldn't say numerous, but a few times, really knowing the difference between discretionary and non-discretionary bonuses. So a discretionary is basically like me as an employer, I'm going to decide to give you a $500 bonus at the end of the year for no reason. Just decided I wanted to do that. A non-discretionary bonus will be that bonus was really written in your employee contract, or the employer said, if you bring in 5 new customers by the end of the month, I'll give you a bonus. So you earned it, you knew you were going to get it. It was non-discretionary. It wasn't at my discretion as the employer to do it. I told you that if you met this, then I have to do what I say. So that's non-discretionary. And really, it's making sure that if those employees receiving those types of bonuses receive overtime, that the overtime rate is being handled properly. So whenever there's a non-discretionary type pay, that might skew your rate of overtime pay. It really skews your regular rate of pay, which then ultimately skews your overtime rate, because you can no longer say, okay, this employee was making $17. I can't say that the overtime rate is 17 times 1.5. I have to make some additional considerations because of that non-discretionary bonus. So if you're having situations like that, again, my contact information will be included in the follow-up. So make sure you're reaching out. I've seen a couple of Department of Labor audits this year that have been a little bit concerning in that regard. Another thing to point out with that is if you are paying your employees a different hourly rate for multiple jobs and they're getting overtime, there's also rules on how that overtime rate needs to be calculated. So just taking that into consideration as well. And as I had mentioned earlier, there's not much new coming for 2023. So I'm just reminding you that it's a new year. You have new forms, so making sure that you're pulling the 2023 W4, making sure you have the most recent version of the WT4 and the I-9. We do have a link to those forms on our website, so I included that. We should always have the most up-to-date version out there for you. It's just a quick way for you to find them rather than having to search each of the websites individually or each of the taxing agencies. And then also a reminder, new year, new thresholds. So when you're talking about the Social Security wage base and the amounts that you can contribute to retirement plans, all of those thresholds change each year to year. So just making sure when you're starting your first payroll in 2023 to make sure that the system is set up for all of those new thresholds. We are starting to see some states that are requiring the higher FUTA rate just because the state owes the federal government for unemployment purposes. There was no states. Wisconsin is not one of those states, but there are a few of them. So just be cautious of that. And now we have time for question and answer. So I'm hoping some of you have some questions or comments or need some clarification.
Yeah, just a reminder, the Q&A function is up at the top near the settings function. So if anyone has any questions on Melissa's webinar, feel free to pop those in there right now. We'll probably sit here for about a minute just to see if any questions pop in. But thank you again, everyone, for being here so far.
Yeah, I really appreciate you joining me.
All right, I'm not seeing any questions popping in yet. Oh, actually, just kidding. We have one that just came in. It says, do nonprofits get 1099 NEC? Melissa, if you want to unmute yourself.
Yep, sorry, I was
that.
muted.
No worries.
Oh, that's a good question. So when they complete their W-9, they should be telling you what type of entity they are. So we just have to follow that. So it's all dependent on how they complete that W-9. I am not a nonprofit expert. My gut tells me that they are corporations. And there are, on that W-9, there are some this box 4. So it's really defining, the nonprofit has to tell you, basically, is what I'm trying to get at. Because it just depends on what the service is for. So I know that's not very clear, but when you request that W-9, they should be filling this out, and that should be based upon that is whether you're going to be giving them a 1099 or not. But I can get a clearer answer for you for our follow-up that Lauren will send out in the next few days.
Yes, just as a reminder, there will be a follow-up email that's going out within the next couple days, maybe early on next week with the follow-up with the presentation slides, this webinar recording, and a full Q&A report. So if you have any questions that you haven't thought of today, Melissa's contact information will be in that follow-up email, so you can contact her, reach out for any questions that we may have missed for today. But with that, I am not seeing any more questions popping up in the Q&A. So with that, again, thank you everyone for attending today. We really appreciate your time here spent with Melissa and I at Kerber Rose. Again, we will be providing that recording and the webinar presentation slides at a later date. Again, kind of targeting towards Monday. Please visit our kerberrose.com/payroll services to check out our other services to learn more about how Kerber Rose can assist you. But I did just notice that we do have one more question pop up in the Q&A, so I'm just going to go over that really quick with Melissa. It says, what happens if they check other on a W-9?
I will follow up with that one too, because I have never had anyone check other.
Melissa, are you saying you're going to follow up at a later date?
Yes, I'll follow. Yep, I'll follow up with that on our discussion or on our follow-up on Monday.
Okay, wonderful. Thank you. Well, again, thank you everyone so much for being here today with Melissa for the webinar. Again, if you have any questions, Melissa's information will be attached in our follow-up. So again, thank you so much. Melissa, if you want to say thank you as well.
Yes, thank you. Thanks, everyone.
All right. Have a great day, everyone. Thanks again.